and welcome to CNBC TV18's Mumbai newsroom. I'm Sumaira Abdi and you're watching MF Corner. Now, one peculiar trend that we want to cover today is basically the behavior of retail investors in mutual funds. Now, of course, things have picked up over the last 2 years. But, in the recent past, when we have seen the foreign investors exiting India, we've all heard of how the domestic investors actually held up the market together. But now we are seeing that, the foreign investors are returning to the Indian market. But this is the first time where we see that, there is equity flows actually net of SIPs are turning negative. I mean, what is this behavior indicate? What are the lessons of the last 2 years that retail investors have learned, and how can those lessons be applied for the future? All of those are questions that we'll be asking Kalpesh Ashar. He's a certified financial planner and also heads Full Circle Financial Planners and Advisors. Kalpesh, thanks very much for joining in to talk about this. But, I want to break it up. Let's talk about the equity mutual funds first, because, there's a certain type of investors who have been there. And one of the things we notice, recently is that are there some chinks in the armor? Let me ask you, you have your finger on the pulse of retail investors. Do you see any sort of trepidation creeping in?
Thanks, Sumaira, for having me on the show. And, this is a very pertinent topic, the lessons for the mutual fund investor. And as we've seen, and as you rightly put in the beginning of the show, that in the last, probably we could now summarize it as last 5 years, half a decade, that there's been a lot of trial by fire for the retail investor, to put it, And come what may, I would actually say that he has withstood all the trials and the tribulations which have come forward through the market volatility and the positives and the negatives, and he has still come up with his head high. So that is for the retail investor, and lots of things have transpired in the last 5 years. So the lessons, the first and foremost thing which I would like to specify here is that over the last decade, now I will stretch it a little bit further, the investor has slowly but surely understood that mutual funds as a passage of investment. I would not say that's a product; it's a passage through which an investor invests. Is the most reliable and the most comforting way of investment, be it into the capital market. So whether he wants to have a chunk in equity or in debt, gold, or whatever it is. And he has, also undergone the hand-holding, in fact, by the mutual fund distributors, of late the RIAs, and has adhered to his strict discipline of regular investments. So that is, fructifying into the numbers which we've been seeing. And the SIP numbers, come what may, is the biggest testimony to that. And if you see in the last 5-6 months, there has been a steady flow of SIPs of almost 10 to 12,000 crores into the equity markets. Now, obviously, what you said is right. The equity net inflows might be less, but the retail investor is participating through the SIP route. And the barrage of FII selling which we saw in the last 6 months, that is the geopolitical tensions of the Russia-Ukraine war. I think the Indian markets have been, somewhat sustained by this equity inflows which the retail investor into the MF SIPs has brought in. So this is surely a trend, and the investor is not shirking off. The answer to your question, Sumaira, is that he's not shirking off. In fact, I have seen many instances that in the last 2-3 years, the investor has in fact been asking that if there is a fall, is this the right time to put in more money according to my cash flow, according to my goals? Should I be, staying put? He has never talked about hardcore redemptions or getting panicky.
Okay, but Kalpesh, not every kind of fund has done well, right? So what are the kind of funds over the last 2 years where the experience has been good, and therefore, what is now the outlook for the future? Where is the portfolio positioning most profitable? Or would you say that you continue according to your asset allocation and it's a long-term game anyway.
No, absolutely right. And in fact, that is the biggest, learning which came out in this last 5 years, Sumera. When we saw that the bullish, phase of the markets were on, and that is, I'm talking about the pandemic period, and the markets just went one side up. There was a spurge or a splurge of NFOs which came up. Obviously, the AMCs capitalized during this period, and there were different themes which were introduced, and different concepts which were introduced, and different geographical avenues were introduced, and the NFO, barrage was on, and obviously there was an attraction by the retail investor. But as time went by, the retail investor understood that the NFOs, the new, old wine in, new bottle concept really does not work, and the tried and tested, the robust, the the real good fundamental stocks into the normal old, tried and tested categories, I would say, which is nothing but your large cap, your flexi cap, mid cap, and small cap, came out with flying colors. So the answer to this is that all the stocks with a stable pedigree, keeping the investment module simple, and obviously SEBI recategorized it. That probably had its pros and cons as well. But what came out is that the funds with a consistent track record and the ones which were managed with a lot of, I would say, flexibility also stood their ground in this entire period. And as we saw, again, the retail investor also has now become very intelligent and aware. As the bullish phase started, going down in the last 6 to 7 months, automatically the NFOs also started vanishing. So he understood that this is a phase where we don't have to get carried away, unnecessarily add clutter to our portfolio, and stick to our funds which we have. Which, if we are a DIY investor, we do it ourselves, or if our advisor or distributor has linked it to our financial goals, so be it. So they have now understood that long-term wealth creation, Samira, is only possible through systematic and disciplined investing, no distractions on the way, and we can, have a good journey in the mutual fund route, even going ahead, overcoming whatever bull and bearish phases we are going to encounter.
But Kalpesh, is this the experience also of direct investors who don't have the benefit of having an advisor handhold them?
Not really, Sumera. I think the direct investors have been lured by that, not paying the commission part of it, or not being attached to a registered investment advisor for their advisory. And they are the ones who have been quite fallible and susceptible. And they are the ones who left the ship when it started, just being a little bit more turbulent. And they are the ones who would not have a good image of the mutual fund industry, because they've, treaded into the waters on their own without being guided. And I feel that whatever it seems like, but in mutual funds, I think you need to have guidance all through the way.
So, Kalpesh, if we were to carry forward the learnings of the last year, would you reckon that this, the same approach that, continue with these market cap allocations, diversified funds are better? I mean, how do you add that alpha, given how volatile markets have been and, possibly going to continue given the way global events are shaping up, and, we have this whole inflation fear as well, running around. Would that same approach continue, or would you need to add, something like a thematic fund, or, more emphasis on mid-cap funds? How do you generate alpha?
So in this manner, Sumira, being a financial planner, obviously, first and foremost, what comes into my mind is the client's financial goals. Okay. Now, if a client's financial goals are easily met over a 10 to 12-year time frame, which we all financial planners advocate, with a 12 to 15% CAGR, ideally, I'm looking at that type of a return. All your large cap, mid cap, and small cap funds, if you see the 5, 7, or 10-year performance, are falling into this category. So by default, there is a certain approach which is there, which we take, and help the clients reach their financial goals. So that is not a problem. Now the question about creating the alpha is always going to be dependent on the risk profile and the asset allocation. And there again, I do not want a clatter of funds to have your financial journey cluttered with. I think if you have a simple allocation of, in case you want to generate an alpha between say around 30 to 40% in a large cap fund or a blue chip fund, and the remaining spread between a mid cap and a small cap, I think that more than 12 to 15% average return is possible. Again, it is dependent on the risk profile and the client's financial goal. So no need to get into all the fancy and the fashionable themes which are going around, because we've seen that these come and go. Even the AMCs have not been interested in taking them forward. The geographical avenues are there. There is a need for international diversification, but today the world is looking at India, Samara, and the growth patterns in India are fabulous. I think we can do the job ourselves.
Fair enough. Okay, we're going to take a very quick break. We've spoken about equity funds so far, but there are other categories as well, debt, what have we learnt, and therefore what can we extrapolate for the future. Likewise, international funds, what's the outlook, gold funds, all of that is... Hi, welcome back. You're watching MF Corner, and with us today we have Kalpesh, Ashar of Full Circle Financial Planners and Advisors, and we're talking about the key lessons that mutual fund investors have learned over the last 2 years, and therefore what can we hope for the future. So Kalpesh, we've spoken already about equity funds. What about that? What about debt? How has the experience been, and what is the outlook now?
So the debt space also has been very interesting, and the type of the movement and the cycles we've seen. I think even the normal, I would not sure to say on a lighter way that the retail investor also has become an amateur economist. So he's understood more or less how the cycles have started moving. And in the first phase, I think during the pandemic, when the interest rates have still not risen and it was a gloomy atmosphere, I think the performance of the short term and the medium term bonds was pretty decent at that time as well. But since the inflation started rising, I'm talking about just the 6 month period post March 22, global geopolitical tensions erupted, and the central banks globally started hiking the rates. I think the debt fund performance has been really suboptimal, and that is all due to the reverse inverse relationship which is there in the debt scenario between the bonds and the interest rates, which is known to all of us. So now they've seen that the last 6 months has been pretty bad for the debt funds. But now, as there have been talks and soft whispers going on that the inflation might have peaked and it's not that cause of a worry, we've seen that the ultra short, the short medium duration funds have again slowly and steadily started giving good performance as well. So that the retail investor in the debt funds become pretty cognizant, and it makes life of our advisory thing a little bit simple. Now, the lesson to learn in this, Sumera, is that I've always believed that in debt funds, stay at the shorter end of the curve. It's always better that in a debt fund, when you invest there, the duration in which you invest in the duration of the fund, I mean to say, is in sync with your intended duration of investment and your financial goals, because then you won't really falter. And the credit quality is of prime importance. Earlier also it held true, and now also it holds true, that just stick to the AAA or the AA credit rated funds and the corporate bond funds. So the target maturity funds, which now because of the difference is there, has started gaining momentum. So the 5 to 6 year target maturity funds, which invest in sovereign bonds, has started gaining momentum. And obviously, again, we are seeing the FMPs coming back into the fold. But as an advisory thing, I personally am not vouching for FMPs, because the closed-ended nature really takes the ambiguity into picture, and I don't vouch for that. The same thing, you can go in for an open-ended fund in a debt fund through a corporate bond fund or a AAA rated fund and achieve your financial goals. So I would not really go in for FMPs, because they do not have an exit option before 3 years. And we've seen a little bit of a bad accident happening a couple of years back in many of the debt funds. So I would not recommend that. And the final thing on debt funds, what clients have learned now, or advisors have told, is do not chase high returns in debt funds. That debt fund which is there is not for generating that extra alpha. That portion goes to the equity. Debt funds are more tax efficient than the other fixed income investments post 3 year period.
So Kalpesh, for now, why wouldn't an investor look at, say, something like a hybrid fund, at least a debt plus investor, where you have this, safety of debt, but for the time that you're not able to make reasonable returns, why can't you get some alpha from equity? I mean, isn't that compelling enough?
Yeah, I'm not anything against the balanced advantage fund or the hybrid type of a fund. The combined return of that probably would generate an alpha. But again, Sumera, the balanced advantage fund comes into the equity categorization. And if you're calling for hardcore asset allocation, then it is a little bit bent towards the equity. And the other thing which has always been my contention is that the debt portion in a hybrid fund is still not, as well regulated or quite clear in their, content or their fact sheets as to, what are we talking about as per the like how equity funds are regulated by the SEBI categorization. The debt fund field is still open. So I really would not tread into that space, but obviously there can be a portion or an allocation taken to the hybrid funds as well.
Okay. What about international funds? Now there are no more fresh investments. So what is, what do investors over here do?
Yes, in fact, that has been a little bit of an enigma, Sumera, the international funds. Just when we thought that it was catching up well with the retail investor, and a lot of investors started getting interested in this international funds, and obviously the AMCs capitalized on it. They launched host of international funds, and the participation seemed to be increasing. The markets were in a good space. Came the RBI regulation of imposing the cap on the international funds. Now that just came as a bolt for the retail investor. Obviously, RBI would have its own call on it and would be doing the discreet thing, no doubt about that. But that came as a bolt to the retail investor, and everything stopped. And just adding a rubbing salt into the thing was that the international funds also could not increase their exposure when the markets were collapsing globally. So the retail investor who wanted probably to have more of a participation was again caught at the wrong end of the curve. So it goes back to the same thing that as and when this window opens up, I would again say that just keep your exposure not more than 10 to 15% in international equity funds as a diversification. But I would still love the India growth story and stick to that for sure.
Okay. What about gold funds then?
Okay, so gold fund again has been a mystery, Sumera, that everybody thought that these periods when the markets collapse or there is international turmoil and there's geopolitical tension, gold would be an outperformer and it would show its true glittering color. But that hasn't happened. But giving due credit to whatever gold funds stand for and the gold itself is that at least it has not collapsed like the other things, and it has given a decent, 5 to 6% type of a return. But again, what was expected out of the gold thing, and those are various other economic reasons why gold has not gone up. We are talking about the MF aspect here. So at best, it again remains a hedge against your inflation and a brilliant way to have liquidity on your hand in your mutual fund portfolio, but again restricted to not more than 5% in your portfolio.
Okay, Kalpesh, thanks very much for joining in. But before you go, just, if you can summarize what is your recommendation now, given that, these experience of these last 2 years.
Okay, so I'll summarize it in 4 points, Sumera. First is that stick to your investment-linked goal planning and allocate your money as per your time duration and financial goals. That is the most important thing. Don't get carried away. Second thing is we are very fortunate that our regulator and in mutual funds, AMFI, have upped their monitoring and have started spreading the awareness campaigns on a big footing. So that's a big plus for mutual fund industry and the retail investor. The mutual fund distributors and the RIAs, the registered investment advisors, are working tirelessly now, imparting right advice and the right execution models. So that is again a good avenue, good passage for handholding and starting your financial journey. And this is paving the way for the retail investor to invest more and more easily into the mutual fund industry in time to come.
Okay, Kalpesh, thanks very much for joining in to talk about this. With that, we're going to wind up on the show for today, but do remember to keep sending us your queries and we'll take them up with the experts through the week. For now, we leave you with some market opinion from Nilesh Shah of Envision Capital. Do stay tuned in. The team of Closing Bell joins you next.
There's already been a significant price erosion. A lot of the froth which has been there is clearly gone. You have two sets of components or players in the IT services space. One are really the big boys, the large guys, the top 3, 4, 5 names. I believe they are likely to be under more pressure because they never had a very strong demand environment. At best, probably their revenues grew at about maybe 10 to 12%. And therefore, the impact of margin pressures will be more felt by them. Versus that, some of the tier 2, the mid-cap ones, the specialized players, I believe the demand environment for them, in fact, will get even better. Yes, that's quite possible. I mean, clearly, if global equity markets are going to be under pressure, if the US tech space is going to be under pressure, if indices like the NASDAQ are going to be under pressure, it's quite possible that we would probably see some softening or moderation in the valuations. Maybe it's not time to be in the generic IT services companies and be in the specialized mid-cap tier 2 IT services companies. That's where the opportunity is going to be from a multi-year horizon.